Here we
All
go.
right, guys. Welcome to the 10th and Roswell investment presentation. Before we go into the presentation, I'm going to go over a few housekeeping items. This Zoom call is being recorded and it will be available on our Appfolio site. We ask that all callers put their phones on mute right now. We will, at the end of our prepared remarks, have some time for a question and answer session. And to submit a question, please use the chat function, and we'll do our best to get your questions during the meeting or at the end of the meeting. And you also are going to be free to add questions at the end.
All right. So for those of you that have been on these calls with us before, you're probably fully aware that we have a great team of lawyers whose job is to make sure that we've made you aware of all the significant risks and uncertainties related to this investment. Those risks and uncertainties are included in this presentation that we're going to be reviewing tonight. It was also in the presentation that we sent out to many of you last week, and it's also in our investor portal. We encourage you to read these statements thoroughly. There's also two things I would specifically like to point out to you in these forward-looking statements and some of the other disclosures we have here. So first off, during our presentation, we're going to be making forward-looking statements regarding our expectations and objectives for this investment. And the forward-looking statements are based on our beliefs and assumptions as of today. Factors or events that could cause actual results to differ may emerge from time to time, and it's not possible for us to predict all of them. We undertake no obligation to publicly update any forward-looking statement, whether as a result of new information, future developments, or otherwise, except as may be required by law. And then additionally, this offering of securities is being made only to accredited investors, non-US investors, and up to 35 non-accredited investors.
Thanks, Michael. So we are excited to present this 18-unit opportunity where our plan is to add value by increasing rents that are on average currently 30% below market, and also by converting 12 out of the 16 garages into 3 different ADUs. We were lucky to come across this property, which is being sold by the heirs of an estate, which is often a good opportunity to buy a property at a good price. Property's in an excellent area, and we're buying at a large discount to what we would have purchased this property for just a year ago. Investors will receive an 8% preferred return, and distributions will begin after the ADU construction is completed. And based on a 5-year hold, the return is projected to be between 1.8 and 2.1 equity multiple. A 2 equity multiple means that you'd be doubling your investment. With a projected IRR of between 14 and 18% return annually. The sponsors intend to invest 5% of the required equity. This further aligns our interests with the interests of our investors. So Michael and I created M Squared to leverage our real estate experience to generate strong returns through multifamily syndication investments and to bring investment opportunities to people who want to learn about real estate investing, people who may not want to invest all their capital in one place or on one property, or really want the real estate investment to be passive. So I'm the CEO of a property management company. We manage about 4,000 units and have roughly 50 employees. About half of those units are in Long Beach, and this is a family business that was started in 1986, and I've been around my entire life. In fact, my mom and dad started as brokers, and I remember sitting at open houses when I was a kid. So I've been very involved, and in particular, I've been involved more recently in many stabilization projects for myself and for management or brokerage clients. I'm a licensed California broker and an Institute of Real Estate Management certified property manager. I earned my MBA from USC in 2010 and a BA in finance from Cal State Fullerton in 2004. And I own over 100 units in Long Beach and the surrounding cities. I purchased my first property in 2004 and actually just exchanged that property last year into a larger property.
So like Michael, I've been around real estate my entire life. My parents have owned several real estate complexes in Long Beach and the surrounding area since I was very young. While doing my undergrad at Cal State Fullerton and actually at Cypress College before that, I worked for a commercial real estate developer and property manager where I got my first exposure to the operational side of the business. Upon graduation from Cal State Fullerton, I worked in public accounting where my main clients were real estate investment trusts or REITs and home builders. And after 6 years there, I went into the corporate world, first at the sponsor of non-traded REITs, and now at a publicly traded REIT with an enterprise value of over $5 billion, where I'm the chief financial officer. I've personally been an investor in residential and multifamily real estate, either directly or through syndications since 2004. I'm a licensed CPA in the state of California, as well as a licensed real estate broker in the state of California. Michael and I, we've known each other for nearly our entire lives. And back in 2021, we decided to combine our complementary skill sets to create real estate investment vehicles, not only for us to invest in, but more importantly, to make real estate investment accessible to folks who probably thought they could never have the capital to invest in multifamily real estate. And in the process, educate them a little bit about achieving personal financial freedom through real estate investment.
So even though we have a lot of experience, we know that we couldn't possibly know everything. So we rely on a group of advisors to point us in the right direction to some degree, and also to check our assumptions and work, since there's a lot riding on this for us and for our investors, and we value our reputation, and we think it's such a critical piece here. So to start, Anthony Horgan is our securities counsel. He's partner and co-founder of the Reliance Law Group. Anthony makes sure that we comply with all the SEC regulations we're subject to, and writes really long disclaimers like the one we had to start this meeting off with. Anthony Walker is CEO of Buckingham Investments. He's a California broker, and he's on this call with us today. He is an owner of a substantial number of units in Long Beach and a syndication investor. Anthony's experience has been really helpful to us as we navigate the market, and he's brought many great deals to us, including the one that we're purchasing for this syndication, the Roswell property.
So Michael got to cover the Anthonys, I get to cover the Jims. So Jim Shute is the senior managing partner of operations for Pacific Sands Funds, which is a multifamily fund sponsor with over 500 units under management. Pacific Sands is based in Southern California, and the principals have built a portfolio in California, Kansas, Missouri, and Texas. And then there's the other Jim, Jim Frings, who's a partner and co-founder of Wisconsin River Partners. Jim is a very experienced investor in many different industries and many different types of real estate. He personally owns 225 multifamily units in Long Beach, as well as investments in other markets. Jim has become a really good friend and mentor to Michael and I over the years, and especially as we started M Squared. And I can speak on my behalf and Michael's behalf when I say that we're extremely fortunate to have such experienced professionals advising us, and we're so grateful for the wisdom and guidance they provide to us.
All right, so we're going to start talking about the investment. These are 3 adjacent 6-unit buildings built in 1964 and 1965. They have a great unit mix of 1s, 2s, and 3s, and some units are very large. Some have vaulted ceilings. Some have 2 and 2.5 bathrooms, which are important because they command much higher rents. Rents are approximately 30% below market, and the buildings have garage parking for a total of 16 cars, and we intend to convert 12 of those parking spaces into 3 accessory dwelling units. Now, ADU law was developed in response to the California housing crisis, and cities don't have a choice on whether they can opt in or opt out. The law requires cities to allow development of a minimum of 2 ADUs or 25% of the unit count for multifamily dwellings. Dedicated parking for these units is not required as long as it's within half a mile of public transportation, and we're probably within a couple hundred feet of public transportation here. We have conducted a feasibility study with our architect and have concluded that 3 2-bedroom, 2-bath units may be added to the property, 1 on each parcel. And there may be a way to get a 3-bedroom unit in one of the buildings, in the Roswell building. So we're currently exploring the cost benefit of using 6 feet of overhang, cantilever overhang to add some space. We've projected ADU completion for 18 months after close, but we already have preliminary plans drawn and will begin working with the city prior to close in an effort to shorten the time frame it takes to get plans approved and construction began. And as you might have guessed, the property will be managed by Borber Property Group. So some of the market details, the property is in a strong rental location in the Recreation Park neighborhood side of Long Beach. It's always nice to see renovated, well-kept single-family homes near apartments. And we have that on this street, especially heading towards Belmont Shore, which is about a mile away, a mile and 7 blocks away. And there's a new duplex condo, which is very modern construction being built just next door at 716 Roswell, which I think will benefit us as well. It's a stable, mature area of Long Beach with higher than average median household income. This property is less than a mile and a half from the beach and close to Recreation Park Golf Course, Wilson High School, Belmont Heights, and Belmont Shore. And to go into a little detail on the city of Long Beach, there has been strong occupancy and rent growth since 2013. Current vacancy rate is 3.8% according to CoStar, and it's a prime coastal community and the 6th largest city in California. We believe that Long Beach is poised to continue creating jobs, and as it reemerges as an aerospace hub and cargo activity surges at the ports, in addition to many other industries and employers moving to the area. So rents for all apartment classes in Long Beach increased at 2.8% in Q4 of 2022. Growth is forecast to slow a little bit in 2023 and rise again in 2024. However, this slowing is very most likely going to be skewed towards Class A apartments, and we can expect rents for this class of property to grow at a slightly higher rate than average projections for the entire city.
So I'm just going to walk everybody through how we got to the purchase price. These are always interesting stories, seeing how the sausage is made a little bit, how we ultimately settled on the price we agreed upon for this property. So these properties were originally put on the market sometime last year for a combined price of $6.1 million. And we believe they were under contract at some point. They obviously didn't sell. Changing market conditions probably had something to do with that. And by the way, this slide is slightly mislabeled. It wasn't listed at $5.3 million. It's listed at $6.1 million. The $5.3 million comes a few minutes later, which you'll see. So we were given a heads up that these assets were still sitting out there in the market, and we immediately started doing some work on them. Off the bat, when we started looking at the financials, something looked off. The expenses were way too low, just didn't make any kind of sense. So it's come up with our best estimate of what we thought would make sense for this property. And we originally put an offer for $5 million. And given that they were asking $6.1 million, we did not expect to hear anything back, because that's about a 20% discount to what they're listing them at. At the same time, we weren't just going to throw out a number to get the seller's attention. It had to be a number we felt good about, that we felt we could transact at, and that most importantly, it'd be something that we could put in front of investors that's going to produce a commensurate return for the risk for a project like this. The seller ended up countering back at $5.3 million. That's where that number comes from. And we ultimately agreed on a price of $5.1 million. So we started going through diligence, did our inspections, discovered some issues with some of the units, electrical panels, things like that. And at the same time, we're seeing a pretty sharp uptick in short-term interest rates, which was going to cause the borrowing costs on a project like this to increase pretty significantly. And at that point, because of all the additional work that we uncovered during diligence, plus the cost of borrowing, Michael and I were ready to walk. We're like, even at 5.1, we can't make this work. It's going to, be a little too risky for what we're comfortable with. We submitted a request for a price reduction, ultimately got down to a price of $5 million plus an extension of the escrow period, which was huge for us. Part of our financial diligence and underwriting, there's a very large focus on the basis of our investment, because it's always, it sounds obvious, but it's always easier to make money if you buy at the right price. And because of that, we feel really good about the price we're going in at and the basis we're going in at. So a couple of stats along those lines. On a per unit basis, this project is 3.4% below market when compared to non-stabilized properties that have transacted recently. And on a per square foot basis, it's 10.7% below market for non-stabilized properties. And while those stats are important, probably what's even more important is where our basis is going to be once we complete all the improvements to the property, get the rents up to market, and build the ADUs. So when we look at stabilized properties that have transacted in the market recently, this property, with all the costs and all the additional capital put into it and accounting for fees and everything like that, we project that our per unit basis is going to be 17% below market and 12% below market on a per square foot basis, again, compared to stabilized properties today. And what those numbers do, that gives us a high degree of comfort that we're going in at an appropriate entry point for this investment. And not only that, that we will have an investment balance that we'll be able to recover and hopefully greatly exceed once we go to exit this property somewhere down the road. So it gives a good comfort and good baseline for how we move forward with this investment. A couple other quick notes on this slide. The cap rate for this property is the purchase cap rate of 3.6%. Market in that area is around 5%, maybe a little bit below 5%. The reason why it's 3.6% is because the rents are 30% below market. And as we note here, just by getting those rents up to market, that cap rate or that return, that initial yield, if you want to call it that, goes up to 6.4%. Once we're able to build the ADUs, once we're able to get all the rents up to market, then we start really getting some really nice returns there, anywhere between 6 to 7% on the, once this property is stabilized, which is nearly double what we're going in at. So said differently, if we just bought this property and sat on it, you're getting about 3.4% return on your money. Through the activities that we're going to be putting in here from the ADUs and bringing the rents up to market, it nearly doubles that.
All right, so I'm going to show you guys the property now. You see our photos here. That front property on the left-hand side, that's 4200 and 4212 East 10th Street. That Tudor style property, we've got two car garages on each side. So a space for 4 cars on each side, and that is what we're going to be developing into ADUs on that building. On the lower right-hand photo, you're going to see on the right side a Spanish tile roof. That is the next property, which is 930 Roswell. So this purchase is for those three different parcels, 3 different structures. And actually, the 916 Roswell property that I was telling you about is having some materials delivered. There's a truck right out front, and so when these photos were taken, those were already under construction and materials being delivered. Next slide. All right, so this is the 930 Roswell building. This property has 4 garages in the front and 4 garages in the rear. So we've decided to develop the 4 garages in the rear into an ADU and potentially use the cantilever overhang in large part because we can maintain parking here on the front of the property. One of those garages, the leftmost garage, has direct access from unit number, I believe unit number 2. And the other, well, all garages obviously have room for one car inside and 1 car on the outside. This is one of the nice things about this development. Some other ones we've taken parking away completely, and we're able to maintain 8 car spaces on this one. On the back of the property, those 4 garages, we're going to be using the existing laundry room and as part of the ADU, and then we'll be developing in-unit laundry for this building. This is where many of the larger units are: 3-bedroom, 2.5 bath here, 3-bedroom, 2-bath, and 2-bedroom, 2-bath units. Now the next photo is the interior courtyard area of the 4200 and 4212 10th Street property. Not a lot of room for planters or anything there. We're considering putting some fake plants out there. We'd like to dress it up just a little bit, but generally speaking, a nice clean courtyard area. On the next slide, we've got the interior of a few different units. On the left-hand side, there are 2 improved units. The rest of the units look more like the photos on the right-hand side that need to be improved. Either have carpet, well, they all have carpet. They have some tile floors, some countertops that are not very modern. And so we're going to be making our units look more like the ones on the left there. And, because we have 2 properties here, three different parcels, but the 4200 and 4212 properties need to be sold together. We suspect that that we're going to be able to take advantage of selling them to two different buyers. Generally, you can get a greater price for a property with a lower price point based on rents, because there is more competition at the lower price point. So that's something that when we list the properties together, we're obviously going to give buyers the option to buy them separately, and I think that will benefit the ultimate sales price.
As we talked about already, the key strategy here, the key way that we're going to be creating value in this project is through turning over the units and also, building the ADUs. So I'll just speak a little bit on turning over the units. Because of where CPI sits today, we're allowed to raise rents by up to 10% this year, and probably for a couple years into the future. But even with that high of an increase, it's going to take a very long time to bring these rents, which, like we said, is about 30% below market, up to market level. So our intention is to be more proactive and look to get tenants out or get tenants to move out by offering tenants cash for keys, which Michael is going to address on the next slide. This is a strategy that, Michael referenced earlier, has become more prevalent since, beginning of 2020. When we first started M Square and we did our first syndication in 2021, we were a little hesitant to employ this strategy. One, was our first deal coming out of the gate. The first property we acquired was probably, 14% below market, 13% below market. So not as severely below market as this. And we knew that there was going to be a bit of execution risk in trying to put a plan like this into place. Since then, we've had a pretty significant success with doing this that Michael's going to talk about in a few minutes here. That gives us, additional comfort, additional confidence that we could use this as a viable strategy to get these rents up to market in a cost-efficient manner and provide value to our investors. So, once we do turn over these units, our model is assuming that we're going to spend between $13,000 and $20,000 per unit to get them rent ready. And then once the units are at market, we're forecasting increases, annual increases to rent between 3 to 4% per year. In the appendix of this presentation, we have a detail of the rent rolls that we're assuming both in our low end of the range, or low end of our target range, and the high end of our target range, as well as rent comps and other assumptions that are driving the results that we're talking about here.
So as I mentioned earlier, we're going to be building 3 ADUs for a total square footage of 2,400 square feet, and we might be able to add another 240 square feet to create a 3-bedroom on the Roswell property. Each ADU is going to be 2-bedroom, 2-bath with, as I mentioned, potential for a 3-bedroom as well. The architect has been engaged and plans have been drawn, and we plan to submit these plans to the Long Beach Planning Department prior to the transaction close. In fact, we're probably going to be submitting for 10th Street in the next couple of days, because we've already made a decision on those plans, and because each property is going to have its own separate submittal because they're separate parcels. The total cost is estimated to be between $674,000 and $735,000. That is between $275 and $300 a foot, respectively. And the incremental annual NOI generated by these units is expected to be between $70,000 and $76,000. And this represents between 10% and 11% return on development cost. So if we apply a 5% cap rate to that, that implies an increase in project value of between 1.4 and 1.5 million, or between $674,000 and $735,000 spend in terms of development costs. So that highlights why the ADU strategy is incredibly valuable in adding value to these syndicated properties. So in the appendices later on, you'll also find that we've got rent comparables there and the plans for the 10th Street ADUs that are there as well. We just received plans for the 3-bedroom and the 2-bedroom options on the Roswell property. We'll be making a choice on those in the next few days. So there's also an additional upside to forecasted performance through the implementation of REVs. which is a ratio utility billing system that we are at Borba Property Group. We're starting to implement on all of our properties. And basically what this does is it takes a water bill and splits that water bill up amongst the units based on occupancy and square footage. So essentially, we're able to recover many of our utility costs for gas if there's a common hot water heater, for water, and for trash. So we'll implement this strategy on any unit rented by M Squared and potentially include it with future rent increases depending on market conditions and our ability to vacate current units. So there's no rubs assumed in our current projections. That's something that would be an extra bump to our return. Now, as Michael mentioned earlier, we have had a lot of success using a cash for key strategy. We were concerned initially in the execution risk, but we've had a lot of success. And in fact, we purchased a property in November at 2391 Locust. That is our Fund A property. And we projected that we would be turning over those units, which were, by the way, about 45% of market. So, much lower than these Roswell units are. We projected that we would do cash for keys, employ that strategy in 7 out of 8 units, and that we would be doing that in the first 2 to 2.5 years. Now, first of all, we have some very talented team members, but also using a strategy that has worked really well for some of those team members and other projects. We were able to move out all 8 units in the first 2.5 months of owning that property. So right now that property is currently undergoing a complete overhaul, right? We've got 8 units vacant. 2 of them are ready to go to market. The other 4 will be at market in the next 2 weeks. The building's been painted on the exterior, new roof. Anyways, the point is that we've had success with cash for keys. And we think that we can't promise that it's going to be the same level of success with this property. And in fact, we're probably not going to go for it because some of these rents are quite close to market, and we can almost get there with a couple of rent increases. But we do think that we're going to be able to employ that strategy and have success doing it as we've had in this other property.
Yeah, one thing, sorry, I was going to just chime in on the cash for key. So when we're doing the Fund A property, questions were brought up about that strategy and, what happens to those people when you give them, $5-6 grand and they vacate your space, they just disappear into the night. One of the things that I think is an advantage for us working closely with Borba Property Group is, given their scale, not only are we able to give them some compensation to vacate their unit, and then, we renovate the unit and bring the rents up to market, but that person who is leaving that or vacating that unit, we're able to help them find a new place as well. So not only are they getting some cash in their pocket to relocate, they're actually getting help landing in a new spot, in a new apartment. And I think that's important. I think there's a misconception that these people are just getting put onto the street or something, which is not something we would ever consider. So want to make sure that was clear for people.
Yeah, I think we relocated 3 or 4 of them into our existing units. A couple of them didn't qualify, and so we couldn't help them. But those that qualified, we were able to relocate to some of our other buildings. So the reason we've had to employ the cash for key strategy is because on January 1, 2020, AB 1482 was enacted. Statewide rent control is in place, and that limits an owner's ability to give no-fault eviction notices. So as I mentioned, instead, we're going to attempt to compensate existing tenants to move by paying them upon vacating. And we've budgeted $10,000 per unit in our operating model. Generally, we've spent less than that, but we prefer to be conservative here. If tenants refuse to vacate, we can offer improvements to their units in exchange for an increase to market or near market. We've had success doing that as well. If tenants refuse a rent increase in exchange for improvements, we can still increase their rents up to 10% a year. Or we can, at a very worst case scenario, last resort, force a move by making substantial improvements to the unit, which are allowed by 1482. And there's additional guidance by the city of Long Beach on how to do that in Long Beach. Our forecast assumes that we're not able to vacate 1 or 2 of these units that have rents well below market, and the return will vary based on the actual results compared to our estimate.
Next slide goes over the capital needs for this project. And as you can imagine, the primary capital needs are for the ADUs and the construction of the ADUs, as well as the costs involved with cash for keys and turning over units, as well as there's some electrical panel upgrades that we have to do upon close. That were discovered when we did our inspection. So over a 5-year hold period, we're estimating that we're going to spend between 1.28 million and 1.31 million on capital. As Michael was alluding to earlier, we're going to be turning over between 13 and 14 of the units in the building, depending on what end of the range you're looking at for our forecasting over that first 18 months of ownership. And that's going to require between 230,000 to 243,000 to renovate those units, and between 130,000 and 140,000 for cash for keys. We're estimating for cash for keys 10,000 per instance that we use that strategy. When we just on the Locust property that Michael was discussing earlier, that came in quite a bit below 10,000 per instance. However, we're still going to budget 10,000, and hopefully it comes in below that and we have a pleasant surprise. As far as the ADU costs, as you can see here, we're estimating between $275 and $300 a square foot, which comes out to between $674,000 and $735,000 in total for those ADUs. On the next slide, I'm going to talk about the loan facility that we have. But as part of that loan, we have to put up a $55,000 interest reserve with the lender. A portion of that reserve is going to be drawn down over time and applied towards our monthly debt service payments. For modeling simplicity, we just assume that $55,000 interest reserve is going out day one and not coming back to us until around the end of year 2 when we're doing the refinance. General capital for the first 2 years of about $34,000 per year, and that interest reserve are all going to be funded with proceeds from this equity raise. Everything else you see on here is going to be covered by the loan that we secure, which I'm going to just touch on this next slide. So because of how low the rents are on this property, getting a conventional loan would have been pretty challenging. So we've leveraged our connections in the real estate finance space, and we secured a pretty cool loan product through actually a new banking relationship. For the Locust property, we use something similar, which is called a market rents loan, where the lender looks at what the rent should be at, and they give you credit for that in the form of additional proceeds. So this is similar to that product that we use on the Locust property. However, the other nice feature about this loan is that it also provides us with $1.15 million of additional capacity that we could use for the turning over the units and building out the ADUs. The interest rate for this loan, or any other market rates loan for that matter, is going to be higher than what you would get for a conventional loan. In this case, the rate is 6.63%. But when you factor in that we could get more loan proceeds up front because they're giving us credit for the market rents, the fact that we are getting proceeds for the improvements of the property, that all means we have to raise less equity, which in turn improves the IRR to our investors by a conservative estimate of around 200 basis points. This is a 3-year loan with a 3-year extension option. The loan is recourse to Michael and myself, and we will be executing personal guarantees for this loan. When we first locked in the rate on this loan, it was over 7%, and we were contemplating paying a 1-point loan fee to get that rate a little bit lower. But in recent weeks, the 3-year treasury rate, which is what the rate on this loan is based off of, fell pretty dramatically, and we took advantage of that. And we did a one-time repricing on the loan, which got the rate down to 6.63% without having to pay a point. Because of all that, there's a little minor correction to this slide that I just want to point out, which is during the extension term, I think we noted on here that it would be the U.S. Treasury plus 225 or 628 as of today. That would have been if we paid the 1 point. Since we didn't pay the 1 point, it'd actually be about 30 basis points higher, or about 6.58% today. Could hopefully all be a moot point, because we would plan to be refinancing this loan during the first 3 years of the loan term. Presumably because at that point we've created so much value in the project and rates have moderated a bit that we could pull out some equity and distribute it out to our investors, and then we're rocking and rolling from that point.
So on the next slide here, you're going to see a summary of our projected distributions based on the high end and the low end of our target range. So the assumptions that we're using for the high and low end are in the appendix, and I'll show you those a little later. And note that the return of capital in year 2 is a result of a refinance, and most of the return comes upon sale. So just to go over the high end of the target range, that first line there, you'll see preferred distributions. And there will be a catch up at the end for those preferred distributions if they don't reach 8%. But in this case, they definitely will. The distribution of profits, it comes in year 5 upon sale of the property. And as I mentioned, in year 2, that return of capital is a result of a refinance. And in other years, it is, I believe, because of the being over 8% return.
Mm-hmm.
Yeah. So on the next slide, you'll see that we've got return sensitivities. This is something that we like to look closely at, and it helps us understand what the worst case and best case scenarios could be. The greatest lever in terms of return is the going out cap rate, as you can see. If we sold at a 4.25 cap rate, which was definitely achievable in this market just 12 months ago, we might get over a 23% return in year 3. And so cap rates, if you're not familiar with them, are a little counterintuitive. The lower the cap rate, the higher the price. The equity multiple is how much the investment has grown to in the investment period. So for example, if you look in the bottom left corner, the highlighted 4.75 cap rate and 5-year hold period is a 2.06 equity multiple. That means that your $100,000 would grow to, in 5 years, a return of $206,000 total return. So investment return of 106 and return of your original investment of $100,000.
With any syndication, the sponsor fee structures are obviously a very important part, and there's of course legitimate costs that sponsors incur and risks that they take on in order to put these opportunities together, and getting compensated fairly for this is generally not controversial. But there are instances where an issue could arise with regard to sponsor compensation. And the first is when sponsors are making fees for everything under the sun, regardless of performance. Before we did our first syndication back in 2021, and even after that, we looked at a lot of other syndications, and we saw that there were upwards of 7 types of fees that sponsors could charge, which we thought was a little bit overkill, a little bit crazy. So we wanted to make sure that our fee structure, that we could keep our fee structure, as simple and straightforward as possible. And it's basically what you see here. An acquisition fee of 2% of the purchase price, a disposition fee of 1% of the sales price, financing fee of 2% of any loan that Michael and I are required to personally guarantee. And then there's an annual asset management fee of 50 basis points of the initial invested equity capital. And that effectively just covers our overhead for managing this investment on behalf of our investors. The second thing that creates an issue within syndication is that oftentimes there's not a clear alignment of interest between the sponsor and the interests of the investors. Syndications typically have a mechanism to reward the sponsor for performance over the life of the investment. These are sometimes referred to as success fees or incentive fees or promoted interest. In the appendix, we give a breakdown of our promote waterfall. And it's something that we spent a lot of time thinking about and making sure that we've constructed it in a way that very closely aligns that compensation with the investment objectives of our investors and their interests, most importantly. At the end of the day, our job as sponsors is to generate solid risk-adjusted returns for our investors. And if we can't do that, quite frankly, we don't deserve any kind of outsized compensation. We should only be successful. This is something we take to heart and we bake into every single deal that we look at. And why we invest in every single deal that we present to investors is we will only be successful if you all are successful, period, end of story. We want to make sure that we're only, getting we're only getting compensated. We're only succeeding if our investor is succeeding, because there's no other way to do it besides that.
All right, so here is the investment ask. The total equity raise is up to $2.5 million for this deal. The minimum investment size is $25,000. That's down from the last one, which was $50,000. And the idea here is to get more people involved and more people excited about investing in real estate. We've also had a lot of success with people investing their IRA or 401k. Generally, you can transfer those funds or roll them over to a self-directed IRA and invest in a vehicle like this. And people like to do that generally because they don't have to pull as much cash out of their pocket, because they can diversify their retirement funds out of the stock market. But something very important that I want to mention is that if you're interested in doing this, you have to start now. We can refer somebody to you, but it takes several weeks to get the self-directed IRA set up. The maximum investment size is $625,000, because if anybody owns over 25%, they would have to be on the loan. Accredited investors are welcome, as well as a limited number of sophisticated investors and non-US persons. Now, the investment timeline, the opportunity is open to investors immediately. We are looking for soft commitments by the end of this week, March 31st. On April 7th, we'll have syndication and subscription documents signed. By the 14th, we're going to ask investor funds to be wired so that we are ready to close on April 28th, which is the scheduled closing date. And I'm just going to go over a few of the appendices for you right now. The first three are annual results and key modeling assumptions. So this is the high end of the target range. The next is the low end of the target range. And the next is our assumptions, what the high end and the low end are based off of. Appendix B is the detailed sponsor fees and waterfall. Like Michael mentioned, we want our incentives to be aligned with yours. So you'll see in the waterfall that we don't make large returns until our investors make large returns. Next, this is a chart that I provide my property management clients on a monthly basis about collections and vacancy. Vacancy on this one is a little bit higher than what CoStar reported, but that's because we have the Fund A building completely vacant and one other building almost completely vacant as well. So our true vacancy rate is probably about just under 4%, as CoStar has suggested. On the next appendix, you'll see that we have our current rent roll analysis for the high end and the low end. You can look at that, and if you have questions about any of this stuff, please contact Michael or I. And Appendix E is going to be 3 sets of rent comparable analyses for the 1, 2, and 3 bedrooms. And finally, Appendix F is going to be our preliminary ADU plans. You can see the layout there for the 4200 through 4212 10th Street building on the right. And that is what the 2-bedroom unit is going to look like. And just before our call today, actually, I received the 3-bedroom drawings, and so we're going to be working with our architect on that over the next few days, so that we can submit it to site plan review in the next couple weeks. So that is the end of our prepared presentation. We are now happy to take your questions, answer any questions that you might have. And Michael, I wonder if you could take it off of the spotlight mode so we could see our guests.
All right. I can figure that out.
All right. Are there any questions out there for us? David?
Hey, Michael. Yeah, I've got a couple questions.
Yeah.
You know me.
Yeah.
So what are the key metrics that drive your assumptions to low and high? Like, I always look at what's got to go bad, what's got to go right from, to get to a delta from 14 to 18%. What do you look at?
So, I mean, we've talked about our assumptions include annual rent increases over the next 5 years. General vacancy. Right now we're closer to 4%, but last year we were in the 2 to 3% range. and keep in mind, this is over the next 5 years, right? This is an average for the next 5 years. ADU construction completion, because the sooner we get those completed, the sooner we have rents coming in for those units. ADU rent start month, similar metric. ADU cost per square foot. On the first building that we did, we projected cost per square foot that were too low. In fact, they changed. Cost per square foot changed so much in that year after purchasing that property because all the supply chain constraints and material costs were through the roof. So we're being pretty conservative with these numbers. Annual operating expense growth rate, insurance expense growth rate. It's been growing pretty quickly. So we're projecting higher costs for insurance growth over the next 5 years. Annual property tax growth rate, but exit cap rate is really, David, the one that is the biggest lever that we can pull. And I mean, we can choose when we want to sell this property. We say 3 to 5 years because we're going to look for the time that makes the best sense for our investors to sell this property. And last year, this property would have sold at a 4.25 cap, no problem. And that's why I talked about it. That would result in a 23% return. But I don't know that's going to happen for sure. And so I don't want to, I couldn't possibly show that to you because I would much rather under promise and over deliver. And the selling expenses are the same here on both high end and low end. But essentially, I should also mention that Michael Costa has run a lot of projections in worst case scenarios. And we're coming up with things that are like 10 to 12%, right? And if there's a 10 to 12% return, it's most likely a function of the market, and you may not have made good money in any real estate investing. We have this. We love the idea of buying properties that are value add because we're creating so much value with increasing rents and adding ADUs. That we don't have to depend on the market quite as much. If we were buying a property, on the other hand, that we were just depending on rents going up and just depending on the market cap rates going down, I would be more concerned because I want to make sure that we can offer you the greatest return and the greatest probability of that. But we're adding value, so that really reduces the low end. Michael, I don't know if you have anything to add to that.
Yeah, the only thing I would add to that, and you touched on it, is what I was speaking about earlier on basis and where we're going to sit on a per square foot or per unit, whatever metric you want to look at for basis in our properties. We're going to be sitting at a place that is pretty meaningfully below market, which, like Michael was saying, that gives a significant cushion. It increases the probability that we can exit at a point that would be profitable for us, as opposed to we bought something right now that was, there's no ability to add value to it. It's fully priced. And then you're hoping and praying that you could push rents a little bit more, maybe cut expenses a little bit here, and you're crossing your fingers you could exit at the right time. I mean, that's a little bit more of a gamble, and one that we're not, quite frankly, willing to take. That's why we feel really good about where we're coming in basis wise for this project now, and when we put the capital into it, because I think it really sets us up for success down the road.
I have 2 more questions.
Okay.
The internal rate of return, is that a net rate of return or gross before fees?
That's after fees.
Okay. And what about these are older units? What about earthquake being built to updated codes, that sort of thing? Do you just worry about insurance, or my wife's an architectural engineer, so she knows this kind of stuff, and she always asks, be sure to ask about, earthquake and being built to code.
So 1964, 1965 is not too. I mean, I'd be more worried about a 40s property. But in the biggest risk in these properties is in the tuck under parking. And when we develop the ADUs in 3 out of these 4 areas, the engineers are required to shore up the engineering or the structural to today's code. So and we're not buying earthquake insurance because it's ridiculously expensive. And we're probably not doing anything to the 4 garage complex on the front of Roswell, but there are walls in between each unit and between each garage And we are already going to benefit from the development of the ADUs, and we're adding shear walls inside the ADUs. And that's going to improve the structural integrity of at least those areas.
Okay, thanks.
Any other questions out there?
Is it common not to buy earthquake insurance for investments like this?
Yes, it's very common. In all my properties and in all the properties I manage, there are probably just a few people that have earthquake insurance. And so I can't even tell you what the cost is. It's been a long time since I've looked into it, but it's very, very expensive, reduces the return considerably. I always said, and I don't even know if I should say this on camera, but I always thought that if there was a big enough earthquake that, FEMA would be in here offering really low interest loans to rebuild our properties, and we'd be getting, support if that many buildings were collapsing. But yeah, I don't know very many people with earthquake insurance. All right.
Any other questions?
Yeah, one more. So, what are the new condo comps? What are they going for?
You mean the two condos being built next door?
Yeah, the ones at 916 Roswell.
I don't know what they're being sold for because they're not complete yet.
Okay.
Each time we've been to the property, they've taken a few steps forward. Actually, there's a link inside of the deck because you can see what the building looks like right now. But it is very modern. I must say it doesn't really fit in the neighborhood. But I also think that it adds value because it's something that's kind of cool and attractive. And so I think the fact that it doesn't fit, it doesn't look, 1960s is not really a problem because there are other, there's lots of different architectural styles on the street.
Yeah.
Anthony?
Are you guys planning on doing a cost segregation study?
Yes, we are doing a cost segregation. Michael, can you touch on that?
Yeah, so cost segregation study is a study we've done for all of our investments, and effectively sometimes engineers involved and what have you. Basically, they're taking the value of your property and breaking it down. Instead of just built land and building, it's land plus a bunch of other depreciable parts of your building. And why do you do that? Well, for some parts of your investment that have a shorter useful life in the tax code, you get to recognize that depreciation a lot quicker than if you just depreciated it like a building for 27.5 years. That accelerates the depreciation that we're able to recognize in these investments, which then benefits you as an investor to reduce your taxable income during the first couple of years of the investment. So it's something that we found very beneficial. It's very well worth the couple $1,000s that we pay for it with the benefit that our investors get. We do intend to do that here as well.
Love it. And then on the way out, would there potentially be an opportunity to exchange into the next deal if people don't want to get cashed out and pay the taxes?
Yeah, that's a good question. So for the last two deals we did, we structured those as funds where the idea there is going to be to keep the capital in that fund, buy a property, find a new property, sell, and then exchange into a new one, kind of keep that going and deferring the income taxes on that sale, the capital gains tax on that sale. We did not go that route explicitly here with this investment for one main reason. One, it's a large investment. You're going to have a lot of investors, and you need everybody effectively to be rowing in the same direction in order to make that viable. With that said, let's say we get out to year 4, year 5, and we're looking to sell this, and we talk to all the investors on this. Okay, hey, we're going to be selling this. There's going to be this tax bill coming our way. You want to roll it into a next investment? Everybody's like, yeah, let's do it. We would absolutely, entertain that. But it has to be a conversation we have at that time. And if people are interested in doing it and we have enough people to do it, it's definitely something that'd be worthwhile.
Makes sense.
Right. Looks like that's it in terms of questions. If there's nothing else, then I wanted to let you all know that Michael and I are absolutely available for any of you if you have any questions after the call. If there's something that you missed, we will be sending out a link to this presentation, so you're welcome to go back and check it out. If you don't have the slide deck for some reason, send us an email. We'll send it out to you. Michael, is there anything else?
No, just thank you for your time and all your great questions, and hopefully you'll come along on this ride with us.
Thanks, everybody. Appreciate you.
Great.
Thank
Thanks.
you.